It's time for you to become a HELOC expert. So today I'm going to cover all the basic fundamentals of what a HELOC is and how it actually works. Hello and welcome to the channel. And if you haven't already, don't forget to subscribe for more financial content. So what exactly is a HELOC? A HELOC stands for Home Equity Line of Credit. So let's start by breaking down what exactly is a line of credit. A line of credit is a preset borrowing limit that you can access at any time. The most popular and well-known types of line of credit are credit cards. They give you a set limit and you have the ability to tap in and use that money whenever you want. One of the best features of a line of credit is that even though you have access to this large amount of money, you only pay interest on the actual money that you've used. So if I have access to $50,000, but I've only used $2,000, I'm only being charged interest on that $2,000 that I've used, which is completely different from a traditional loan, because with a traditional loan, you're given the $50,000 and you start paying interest on the entire $50,000 from day one, even though you haven't used any of the money yet. Now with a credit card, you have to understand the debt is not secured by anything, which means if you default on that loan, there's no collateral that the bank can come after. So what they use instead is your credit score, meaning if you borrow money and you don't pay it back, they're going to negatively impact your credit score. And for most people, their credit score is pretty important to them, so that gives the bank leverage to make sure they have something to come after if you don't pay them back. Now with a HELOC, that line of credit is secured because it's backed up by the equity in your home. So here's how that works. Let's say you purchased your home for $300,000 and you did the standard putting 20% down, which came out to $60,000 down. That means you owe $240,000 on your mortgage. So the difference between what your home is worth and what you owe is what's considered your equity. So right from the start, you have $60,000 in equity. Now, hypothetically, let's say your mortgage payment was $2,000 a month, and over the next 10 months, you put another $20,000 towards your mortgage. That would lower what you owe from $240,000 to $220,000. But let's say during that same 10-month period, the value of your home increased from the original $300,000 to now $400,000. So what you do is you take the current value of your home, which in this example is $400,000, and then subtract what you still owe, which is $220,000. That leaves you with a difference of $180,000. And that $180,000 is what the equity is in your home. Now, the amount of money you're able to pull out of your home is dependent on how much equity you have, plus whatever the lender's guidelines are. And lender guidelines may vary, but you're usually able to access anywhere from 80% to 90% of the equity in your home to be able to pull it out in the form of a HELOC. Now, from our example, we figured out that you have about $180,000 in equity. Next, just take that number and multiply it by 80% or 90%. So at 80%, you're able to get a HELOC for $144,000. And at 90%, you're able to get a HELOC at $162,000. So what you're actually doing is using your home as collateral in order to qualify for the HELOC. Because there's two ways to get equity out of your house. You can either sell your home or you can borrow against it. So let's say you end up getting the HELOC for $162,000. You then have the ability to borrow as much or as little as you like. And remember, you'll only be paying interest on the amount of money that you actually use. So that $162,000 will literally just sit there doing nothing until you decide to actually use it. So it's very similar to how available credit works on a credit card. So how do you qualify for a HELOC? For starters, you must have equity in your home like we just talked about. And that specific lender determines how much of that equity you can have access to. You'll also need to have a good credit score. A credit score of about 680 gives you a strong chance of getting approved. However, it is still possible to get approved for a HELOC if you have anything above a 620. And these are just industry standard numbers. So just know that anything is possible because it's still at the discretion of the lender. So if your score is below 620, I would say don't quit without at least giving it a shot. I would still talk to a few lenders before assuming that I can't qualify. Next, you want your debt to income ratio to be at 43% or lower. And your debt to income ratio is just your legal liabilities divided by your gross income. So let's say your current mortgage, your taxes, and your other debts come to $3,000 a month. And your gross income is $9,000 a month. You'll take that $9,000 and divide it by $3,000. So in this example, your debt to income ratio is 33%. And just to save you some time, you can easily just Google debt to income ratio calculator and it'll do all the math for you. Next, you will also need sufficient income. Unfortunately, there's no magic income amount I can give you, but mainly lenders are looking to see that you have the financial capacity to pay back the loan. So definitely be prepared to show proof of income. Another thing you'll need is a reliable payment history. And your payment history is already included in your overall credit score, but the lenders will pay extra close attention to make sure that you pay all your bills on time. And once you do qualify, you must understand that you can use the money for whatever you want. And that can be both a good thing and a terrifying thing to think about. You will literally have the ability to rack up hundreds of thousands of dollars of debt with nothing to show for it. Of course, that's if you're buying things with no value to it. So you must be both responsible and disciplined when it comes to your HELOC. But typically, people use HELOCs to purchase something that has value to it, like other pieces of real estate, maybe remodeling your home or some other type of investment that you're thinking of doing. Some people even use their HELOC to pay off their mortgage faster. And I actually made a video about how to use your HELOC to pay off your mortgage in the next 5 to 7 years. And I'll post a link to that video right here so you can definitely watch that next. Now, there are some things you definitely need to know before even thinking about getting a HELOC. For one, if the housing market crashed and you lose the equity that you once had in your home, the banks or the lenders have the ability to freeze your HELOC, which just means you no longer have access to borrowing money. Another important thing to know is that the interest rates that are attached to a HELOC are not fixed. The vast majority of the time, you will receive a variable interest rate. All that means is that the interest rate that they're charging you can and will change. And the interest rate is usually determined by two main factors, and that's the current interest rate environment and your credit worthiness. So usually the better your credit, the better the rate. No different than any other loan you may get. Now, what they charge is usually the prime rate plus whatever their markup spread is. So let's say the prime rate is 4% and the lender has a spread of 2% that they charge. Your total interest rate that will be charged to you would be 6%. But if then the prime rate changed and went up to 5%, and they're still charging that 2% spread, then your total interest rate will move from 6% to now 7%. And the prime rate can change about every 6 weeks. And that's typically how interest rates are calculated. And that isn't necessarily a bad thing because interest rates can still go down the same way they can go up. Another thing to make sure of is to find out what the lender's caps and their floors are. The cap is the highest the interest rate that they can charge you, and the floor is the lowest that the interest rate can go. That way you'll always be prepared and you will know what's the worst case scenario if you maxed out the entire HELOC and they charge you the highest rate possible. Because the last thing you want is to not be prepared if interest rates do spike. Another thing to know is that HELOCs typically have two phases to them. You have the draw period and the repayment period. The draw period is usually anywhere from 5 to 10 years. All that means is during that time frame, you're only required to make interest-only payments. And once that draw period ends, you have to start making interest plus principal payments until the complete loan is paid off. Also, once that draw period ends, you can no longer borrow from the HELOC unless you refinance it first. And typically that repayment period is about 20 years. And since the HELOC is a line of credit, it's very common for lenders to charge an annual fee just to keep the credit line open, similar to how credit cards operate. Some lenders charge a transaction fee every time you take money out, and even an inactivity fee if you don't use the line of credit often enough. Some HELOCs may require you to maintain a certain balance, so that's definitely something you want to inquire about. Now, when it comes to closing costs, typically the closing costs could be anywhere from 2% to 5% of the entire HELOC amount. So a HELOC for $150,000 can cost anywhere from $3,000 to $7,500. However, there are lenders that won't charge a closing cost at all. And lastly, some lenders may require you to make a balloon payment for the entire balance at the end of the draw period. And this payment can be hundreds of thousands of dollars depending on how much you owe. So the main takeaway is that you definitely want to shop around and you want to be crystal clear about the terms of the contract. And here's a little cheat code for those of you that are not a fan of dissecting contracts. Usually if you take a contract that you're being offered to that lender's competition, that competition will do a really good job at pointing out all the flaws of that contract. And that's still not a perfect solution, but at least it'll give you a good foundation of all the areas of concern. I would say a trusted attorney will probably be your best bet. But overall, I hope this video helped out with your understanding of HELOCs and how they work. Make sure to share this video with all the homeowners that you know. And don't forget to subscribe to the channel if you haven't already. And I'll see you in this next video.